I'm Alex from CoinFund. I work with Jake and the rest of our team. I was very excited to participate and moderate this specific panel because this panel is not about proof of stake. This is the area and the aspect of the whole generalized mining space that is more unique, more case by case, and is kind of being invented as we speak. So gathered here, we have 4 different projects that offer various kinds of generalized mining opportunities. I would like you guys to maybe go in turn and introduce yourself and then talk about sort of, if we wanted to do this for your network, what would we be doing and what sort of opportunity is there?
Sure. All right. Is this mic working? Can you guys hear me? Yes. All right. So my name is Doug Petkanics. I'm the founder of Livepeer. Thanks to everyone who's already talked about Livepeer tonight. I appreciate it. I like to think that's for 2 reasons. One is because we launched on the Ethereum network about 6 months ago. So all these ideas that we're talking about, kind of staking, operating nodes, slashing, inflation funding, these sorts of things are things that you can actually do live in our network, whereas a lot of the projects are going to be coming online very soon, be able to do them there. But it's been nice to be early and kind of get the participation of the community. I think the second thing is hopefully the incentives that we've designed and the opportunities for active participation or generalized mining or mining 2.0 kind of make themselves apparent if you follow the economics. So the things you can do in our network, as you guys have heard, you can run nodes that actually transcode video, and if you're not a video developer, you probably don't even know what that means or care, but it's a very expensive, necessary service for video that's delivered over the internet, which is 85% of the traffic on the internet. So you can do that, and if you don't want to run hardware, you can actually participate in essentially the quality assurance of the network through delegation. So you can delegate towards the nodes who are provably performing the work well, route more work towards them, and then you're aligned, you're creating a better quality network, making it more useful for everyone. So those are like 2 of the opportunities.
Hi everybody, I'm Arjun, Hassard. I'm working on product at NuCypher. Maybe the lesser known project out of the 4 here. We're, in simple terms, a privacy layer for decentralized systems. In terms of opportunities to be a node operator, the network requires a set of proxies that perform re-encryption services on behalf of our users. So that means that they actually manage access within applications or systems. We're fairly early on in our staking design process, so we haven't launched, we don't have a GUI like Livepeer. I'm particularly interested in the methodologies through which you arrive at like certain parameters or certain inflation schedules, etc. So that's what I'll probably talk about the most this evening.
Hello everybody, my name is Pawel. I'm with the Maker project here. So we've been building a decentralized stablecoin. We are live on the Ethereum mainnet since December 2017. And what I think makes Maker interesting from the point of view of this discussion is the way we try to keep the stablecoin stable by creating a set of economic incentives for profit-based entities, agents called keepers. So it's a really interesting space. It's totally open, it's totally permissionless to everybody, and we've been seeing some serious traction in the keepers area, both in terms of like the profit keepers have made, making DAI stable, as well as like the sophistication of the techniques they've been using in order to do that.
Hey everyone, my name is Raul Jordan. I am a partner at ZK Capital. We are an academic research-oriented crypto investment fund. I am also the co-founder of Prysmatic Labs. We are one of the teams working on the implementation efforts for upgrading Ethereum from 1.0 to 2.0, implementing Casper FFG and sharding, an initiative known as Jasper. So yeah, we've been working on that a lot extensively over the past few months. There are tons of opportunities that are still being created. So what I'm personally interested in is that sharding is a significant improvement on the parallelizability of the Ethereum network from its current nature. However, it brings a complementary decrease in user experience if done naively, in the sense that users might have to be aware of shards. If we don't work otherwise, the experience might actually suffer, and the validator requirements and staking economics can take a hit. So a big part of this is actually we have a tool in the name of crypto economics that we can leverage here to improve the experience and offer new opportunities aside from just like staking in Ethereum 2.0. And that's something that we'll love to talk about throughout this panel as well.
Great. So here's the most interesting question. You, to some extent, and I apologize because I said we don't have like proof of stake here, and I apologize that I misspoke about that. But either way, to some extent, you represent projects that have actually designed these types of incentives. And so what I want to ask you, and I actually want to drill into that because this is the meat of the issue to some extent, is how do you see this design in terms of the long-term trajectory of the actual profits that people who participate in networks will be able to receive by performing this activity? So to give you an example, if you look at hardware-based Bitcoin mining, the block rewards and the transaction fees per miner typically gravitate to the energy costs, or in other words, to zero. Is that the case here? Do you see this being diluted to zero, or do you see it achieving a kind of an equilibrium? And if so, then what is driving it up? And I really want to dig into this because economically it's a really important question for the future of the generalized mining space.
I can take a stab at this. So in Ethereum 2.0, we not only have the staking economics coming from validators, but also from experiences such as peer-to-peer relaying of information, and actually state execution, such as executing transactions on smart contracts. It's not going to be something that is going to be done at the layer 1. So it's not going to be something that validators are going to be aware of. Even though the term validator seems like a misnomer, like you're validating transactions, that is not exactly the case in Ethereum 2.0. So we're actually going to be having layer 2 execution engines by which certain executors, which can be third-party agencies, which can be generalized mining agencies as well, that will be executing smart contract transactions and then relaying the appropriate fees and the rewards to the validators that then.
So what do you see the actual fee dynamic there? How do you see the fees increasing, decreasing? Where do you see them kind of landing over time?
Yeah, so I mean, there would be obviously a very interesting supply and demand curve here, not only with the demand for executors coming into the protocol and working with validators. One of the things we are really careful about is off-band coordination. So we take a very close look at like the coordination attacks that can happen in Ethereum 2.0. We're very careful to design systems in which validators can still maintain a good degree of profitability while reaching a good, basically a good baseline of inflation, at least way better than we have today. And that's something that, I think the multiple layers by which you can gain profitability are only going to stack up with basically how invested you are in the protocol itself and the future of the protocol. So if you're a basic validator, for example, working on something like Rocket Pool, and say that you only have 16 ETH that you're able to stake, you can still reap the benefits. You can still reach a certain amount of break even and possibly make some money. However, if you want to get even more involved, participate in state execution, participate in peer-to-peer information relaying, then you can participate and really reap the benefits of the network. So it's really a function. The system is designed with the functionality in mind of just like the more engaged you are, obviously like the more profits you will reap because you are more invested in the benefit of the protocol and how it will grow over time. So we're designing all these different layers in mind while being cognizant of validators' demands and maintaining a high degree of security.
So what I was going to say about this is I think it's important to keep in mind the different phases that these decentralized networks go through. First, there's the bootstrap phase, and then there's the phase when you've reached your scale and you've delivered the impact on the value you're providing. So in our network, I think many networks, fees are essentially paid in dollars like DAI stablecoin or Ether, but the kind of inflationary participation incentives and the security is denominated in a network-specific token. And so in the early days, in the kind of bootstrap phase, before you have significant fees, you have people operating these networks at cost or below cost to basically speculate on the inflationary token, right? And then over time, and that makes the network cheap to use, and that drives actual real usage and real fees being paid in dollars or ETH, essentially. And then as you achieve scale, you have people competing to earn those fees, because now there's a lot of fees being paid in. And the point here is, if you try and take any margin whatsoever, it creates an opportunity for someone else to come in and do the work for closer to the cost of electricity. Like you said, make this network really cheap to use, really efficient for a user. And the inflationary participation incentives can decrease, and people are basically just competing for the fees, and that's okay. The end result is in like an amazing scaled network for users. But we don't have to determine like what the margin is in the protocol or how much money a node operator can make. Like the market can determine that entirely, and they'll settle on some equilibrium that's profitable for actors and profitable for, and really efficient for users.
Yeah, I would say that the Maker platform it's pretty similar to the examples you gave. So it's still, I would still say it's in the bootstrap phase as well. So the profits you can get now are pretty high. Having said that, we expect that as the space matures, a profit will basically target the cost of capital that will be necessary to participate. So it will be like zero from that point of view.
So I think you kind of, the two of you are saying that probably the dilution will happen with time on each of these networks. The dilution that kind of gravitates the fees to zero.
Yeah.
I think it's like be a generalized miner early in the network. Be a generalized miner early in the network to help bootstrap it, and then at scale, be an actual competitive operator with some sort of advantage.
Interesting.
Yeah, ours is while we take inspiration from base layer proof of stake, obviously there are some differences, like you said, including looking at the relationship or lack of relationship between fees and rewards, as has been evidenced in with Bitcoin, for example. In our case, we are subscribing to the idea that fees will eventually will rise and then block rewards will go down, and that will kind of, as you said, the block rewards are an initial incentive to be on the network and keep it running. In terms of the overhead angle, in NuCypher's specific case, what you're actually dealing with as a node operator is just ciphertext, so there isn't a huge computational overhead. So we don't have that same, I suppose, avenue for competitive advantage that you might have with, like, for example, proof of work.
So I guess what I'm hearing is a couple of things. I'm hearing that my next question was going to be, who are your ideal participants? But I was gonna, now that I've heard your answer, I want to amend it to ask, who are your ideal participants, and does it differ by the stage in the lifetime of your network? Because that's what it sounds like is happening.
Yeah, that's exactly right. Like in the early stage of the network, an ideal participant would be someone like, what Adrian or Brian were mentioning before, someone who's going to actually help build the network or add value or contribute something beyond just the competitive operation of the infrastructure, because again, you're at this bootstrap phase where you need a lot built out. You need people who understand the crypto economics, can introduce it to a wide variety of parties, help kind of investors get access into participate. But then at scale, it's going to be people who have a competitive advantage for the resource that's being provided. Maybe the cheapest electricity, the most bandwidth, the best location, proximate to users of the network, the things that can let them do this for a cheaper price than anyone. But it's not just like there's a switch that gets flipped. It's a transition you'll see over time.
Yeah, I think what I should have mentioned in my previous answer is one requirement is being always online, or as much as possible. So I think in terms of the resources you have available, that's extremely important. And then there are some security requirements. I think it's very interesting, the question of sort of what is the barrier to entry for different systems. I think in our case it's probably lower. you could be a node operator without having the most fantastic security chops in the entire world. But yes, we don't have any near-term plans to create a like web portal through which you can stake like Spank Chain.
Sounds like that would be different for MakerDAO because it's not so much a technical expertise, but more of a financial expertise.
Yeah, kind of. I mean, I don't really think that our expectation of how the keeper space will look like really differs with the stage the project is at. I mean, it definitely looks different now that we expect it to be ultimately, but I mean, in my opinion, the only reason it is like that is that the space hasn't gotten competitive enough yet. There are just like only a few, maybe like 100 players in it, and this will definitely grow. But like from the point of view of like keeping DAI stable, I think the most important thing is that there will be like many participants, that this whole space will maintain completely permissionless. So for example, in order to be a keeper, you don't need to hold any token. You don't need to stake anything. There's basically like a set of arbitrage opportunities against on different trading pairs, which you can spot, and then by engaging your capital for like currently it's even for one block, like ultimately that would be a longer period of time because we're gonna upgrade this mechanism. You can just shave some profit and like help the stability at the same time.
So in our case at Ethereum, we already have a main, a running proof of work chain that's currently there, and there is a lot of interest instead in, rolling out the next upgrade in phases such that it will directly benefit the current chain and eventually transition smoothly to a better system. So the idea is that for those that are quite unfamiliar, is that in Ethereum 2.0, we're going to be actually creating a full proof of stake sidechain that eventually will become the main Ethereum chain, and people will gradually transition into, that's where people will actually deposit Ether as a one-way deposit into this new chain and become validators and participate in the system. The cool thing about this is that by rolling it out in phases, so in the beginning, we just have a full proof of stake sidechain pegged to Ethereum. People can deposit money, and then eventually, we can implement functions in the main chain that allow finalization of main chain blocks. So it allows like sync to be faster and the experience to be a lot better. So we get this gradual improvement up until the point where we get sharding involved, right? And when we get sharding involved, the main participants in this case are going to be, obviously like dApps that are currently on the Ethereum network are going to want to reap the benefits of a massively scalable blockchain. Then users, of course, will be missing out on using these dApps as they're in this new chain. So we will be implementing a lot more deposit functions for people to go from the current Ethereum chain to the new Casper FFD full proof of stake sharded chain. So at that point, there are obviously a lot of incentives. There's a large amount of actors that are interested in currently ensuring finality in the current proof of work chain and eventually transitioning into a chain that is massively scalable. So that's what we're thinking about is in a series of phases, starting from phase 0 all the way probably up to phase 4 and above. So, yeah.
Thank you. So here's another question. You see the space from a very different vintage point than we do. We kind of see it from above, and you kind of see it from below. And the question is, do you feel competition from other projects and other networks for the attention from the stakers and participants yet? Or maybe not, and do you expect to? Maybe the answer is no.
Competition is an interesting way of putting it. I can tell you from within, one thing that's evident is you can think that you're designing all of these incredible incentives that any rational actor would want to take advantage of in order to essentially make money. But then what you see in reality is that there's so much mental overhead for a human to learn about your protocol, to understand, to use the complicated UX, to take these actions. And so, Pawel, I don't know, you said there's like maybe 100 actors. I don't know if that was in the Maker network. We have n number of transcoders, which is enormous. People who have these clear incentives that they could have followed from day one to essentially, 4x, 5x, 6x their asset. They kind of were just like, oh, I'll figure out how to do that next week or next month or next year, and they don't necessarily respond to the incentives. So I think it's more about creating the right user experience and
so it's
and
more of a
tools and
UX
access
problem than
competition
than a
with other
competition.
networks. Yeah.
Interesting.
Yeah, I also think that you have to kind of compete for potential agents. I mean, the way we've been doing that, we've been trying to engage with the community and even prepare some reference implementations for them, so they can build a reference piece of software that they can either just try to run, deploy out of the box, and it should theoretically start making them some money, or at least something that they can take and then improve on. And we've been doing some research recently, and significant number of these agents of keepers is actually using something that either is just our software or originated from it in some way. So I think you have to be some kind of proactive here, because there are, as you said, there are many projects, and it's not easy to understand. So you need to kind of help these guys somehow.
I think developer mindshare is definitely a thing. And I think there's sort of two angles to it. One is community engagement and education, and how easy it is to understand how you actually could spin up a node, etc. And then there's obviously the more brutal, rational incentives of how quickly is the inflation decaying, and can I get in early and profit fast. But I think ultimately, over the long run, your would-be operators are going to be thinking, what is the actual utility of this network? Are there going to be fees in the long run? I hope that's
the reason why I'm actually taking the discussion in this direction is because many of you have stated that fees will kind of go down with time, and will require a lot of work and efficiency. But at the same time, we have the competition, where, let's say, some other network gives you more profits and is maybe easier to participate in. Are you worried that a rational player, we'll talk about rational players, will just choose to stop doing Livepeer and start doing Maker, that type of stuff? Oh, that's thinking happening.
Just because our project's a bit simpler, because as I mentioned, there isn't that relationship between the jobs you take and how much it costs to do them as much as other projects, and therefore when I said fees will go up, I mean the total amount of fees going into the network, such that node operators will be earning more, and even if the cost per re-encryption job goes down, they can still anticipate that the amount that they earn from fees will go up. And it won't be eating into their margins in the same way.
That goes along with the question that was asked earlier in the evening about, as a company that does generalized mining, do you focus on one project and do it really well, or do you go, broadly and do many projects? And I think this kind of feeds into that discussion, because it sounds like, players that focus on one specific network could really provide better services and will kind of get better incentives. What do you think of that, Doug?
Well, I guess I was going to turn your original question back around to you guys, which is, if you've invested all this time, energy, and expertise in operating and maybe specialized hardware, software setups, et cetera, into operating one network, and you've staked and put down a multi-month deposit that's hard to withdraw from that network, is it easy for you guys as generalized miners just to reallocate towards another network depending on which is paying the most that day?
But if you lock us up for many months, are we going to go in the first place?
Well, that's the trade-off, and if you don't, someone else can, and they'll kind of see the incentives that you're forgoing, right? So I guess it comes down to how the network is designed.
Well, economics is about markets, right? And there's a market of things you can do, and then there's a market of people who can do them, right? And the balance between those two markets is what is really interesting to me in the whole discussion of economics. Does anybody want to add anything before I go to audience questions? Any questions from...
Yeah, so back when utility tokens were all the rage, a lot of discussion happened around the impact that liquidity and velocity would have on the token. How do you guys think about liquidity in the context of staking tokens?
So staking is inherently a sink, right? It reduces the velocity because there's a typically something called an unbonding period, where once you stake your token, if you want to withdraw, you have to wait the unbonding period. So that reduces the velocity. But I think velocity, as you mentioned, it primarily relates to using the token for payment for a service in the network. And the kind of conclusion that I arrived at, and I think many people have arrived at, is that the payment can be done in any token, essentially. Payment is a high velocity action, and you don't necessarily want your staking token to be your payment token because it provides a different kind of utility and service to the network.
Sorry, so to clarify my question, I'm not asking about like the impact on price, for example, but I know like for Livepeer, for example, you guys have a target participation rate. But presumably, like if you had full participation of staking and there was a thawing period of like several months, then like there would be very, very little liquidity. So for new participants to come in and like buy Livepeer tokens and participate in the network. So what do you think the right amount of I guess what do you think the ideal target participation rate should be to maintain a healthy amount of liquidity so that new entrants can come in and do work in the network?
Okay, good question. So he's referring to a target participation rate in our network. So that's what % of the tokens do we want staked? And we set that at 50%, and that's arbitrary. It might be the wrong value that needs to be moved by governance. But what will happen is we don't have a set inflation rate. Inflation will decrease if we go above 50%. And so if inflation is decreasing towards zero, then you probably wouldn't want to stake more tokens that are locked up for 4 months if you're not going to earn any inflation. So it basically, this target rate ensures that there will be liquidity. There will be some tokens that are not staked for full participation in order to let people enter and exit the network.
So in Ethereum, actually, we by depositing money into the side chain, which is a full proof of stake chain, you will actually be basically relinquishing those coins for a very long time until essentially shards are involved and essentially the majority of the network moves into Ethereum 2.0 and dApps start to become big over there. So essentially right now validators will get a 3.88% annual interest rate, assuming 10 million participating ETH in ETH 2.0. And this is a very large bet you're making, keeping in mind that we will have basically a baby ETH 2.0 chain in parallel with the current ETH 1.0 chain. Thereby, you're taking a lot of money out, assuming you want to be a validator for ETH 2.0 from the current system. And you're essentially just like doing a one-way deposit, which is akin to burning it in the current system. So that's something that validators are going to be very cognizant of and will significantly shake up the ETH economy. And yeah, so we will see very interesting shifts in liquidity in Ethereum.
Just the right percentage of initially locked tokens is a great example of a parameter that we don't believe should kind of originate from 5 people in a room. And then it's true that that can change going forward. It's not forever, but we're exploring other observation-driven ways of setting parameters like that, including like multi-agent simulations, and including also looking at like the historical track records of potential node operators through their on-chain reputation, which I can talk about more, but yeah, it's a good example of a parameter like that.
So in general mining, not generally, in Bitcoin mining, Bitmine is allegedly pre-testing their miners before sending them to the user. This concept could also be transposed to the generalized mining system, where you guys would have an unfair advantage over the quality of the information you have about the system and even the software you're developing and making accessible to the system, to the end users. Do you see that as a problem? And how would you, if yes, how do you make that correct the incentive to make sure that you don't screw your users, basically?
Yeah, so basically I don't think that's a problem in the case of our project, because what you're making opportunity of is basically arbitrage opportunity. So I don't know, if you misaim, you will just not use that opportunity, but somebody else will. So I don't think there is a concept of rogue data, and like the keepers in Maker.
If I can try to answer that from sort of my perspective, the 200 feet perspective, I think it makes zero sense for somebody to do that, because if the network is trying to create an ecosystem, then the network is going to have to rely on the trust from the generalized miners, which is not the relationship you have with Bitmain and Bitcoin miners. Bitmain does not care, whereas the network creator certainly does. And that's the big difference here. And also, there's some of these, I'm going to say most of these opportunities are protocol opportunities. And so the quality of software really is not the same level or economic kind of dynamic as the quality of hardware at all. It's not even close. So to me, I think the answer is definitely no.
But why wouldn't you?
Because you would be screwing yourself, right?
By running a better business?
No, your business is the health of your network, not if you're providing services to that network and somehow screwing the community, then you're screwing the network.
But aren't you just making decisions based off the data that you have to better serve the network?
Well, but then that's not predatory.
But it's making you in a better position, but it's also making the users in a better position. So I think it's just a natural occurrence that would happen in any network with its data to use, right?
Doug, do you want to take that?
I think that's absolutely right. I think it's like a delicate dance where you're balancing like the health of your network and how much you prioritize decentralization and open access versus your own self-interest, which I agree with Alex is mostly aligned with the long-term health and success of the network. But like I was saying before, you're gonna if you're transparent and you're open, you're going to shout from the rooftops about this opportunity and try and convince people to take action in the best possible way. And there's just they're not spending 60 hours a week on this like you are. They're not so knowledgeable with the ins and outs of the protocol. So you probably will have to do a lot of work to demonstrate the value of the network, to make it usable, to build tools, to play the role in the network so that it works well. And I think that's okay. That's the bootstrapping phase. That's Satoshi mining Bitcoin by himself for the first few months or years of the network, right? But at the second that you take advantage of your ecosystem and do something malicious, I think you're working against yourself.
So we've been at this for almost 3 hours. I'm going to take one more question, and I just want to acknowledge that this is amazing how you guys basically paid attention for 3 hours. I've never had this happen at a meetup.
The thing is that I have two questions.
Sure.
Maybe first is, my name is Przemek from Pickpack. First is really a comment to Doug. When you said like 50% staking, I was a little shocked. I mean, that's really high, I thought. Yeah, I mean, maybe you can comment on that. And the second question is, maybe for Pawel. I mean, if one was to invest in a stable coin, what main features, like good features of stable coin, would you list?
Sure. Thanks for the question and all the attention tonight. So the only purpose of the Livepeer token is to essentially stake it and participate in the network. So we don't expect 50% of the tokens to immediately come online as staked. Right now, we've been live 6 months, it's at about 18%. But what will happen is inflationary token go in the staked state by default to only those 18% of people. So if more tokens don't come online to stake, it's those 18% of people will end up owning 50% plus of the network in a couple of years. And so basically it's saying the tokens will be in the hands of active participants. And those who are just passively sitting on it for a long time will essentially be diluted. So it's a disincentive to not participate. The part of our kind of participation incentives. And you made a great point before. It's hard to know that the 50% number is right. But we found it's easier to set that and be rationally accepted by the community than to try and determine what the exact inflation rate we need to set to get 50% is. That is totally unknowable.
Yeah, so that's not an easy question actually, which stablecoin to invest. But I would expect the because there are like few basic stablecoin designs basically, and I would expect the market to convert somehow, and like the most successful, maybe the two most successful projects from like each area to survive. So I would say that mostly in which stable model you actually believe, that's how I would like make this decision, whether you're a senior shares fan or a asset-backed stablecoin like Maker fan.
All right, thank you everybody. Alex, do you want to close? Thank you guys. I appreciate your answers.